Equinor ASA, EQNR, operates from a position of exceptional financial strength, underpinned by its dominant control over Norwegian Continental Shelf (NCS) and a robust capital structure. The company's integrated business model provides critical cyclical stability, allowing it to generate superior returns even amidst commodity price volatility and aggressive capital expenditure associated with the energy transition. Recent financial performance demonstrates a critical strategic pivot toward prioritizing immediate cash flow realization over rapid, costly expansion in the renewable sector, significantly strengthening the near-term investment thesis. 1.1 Summary of Financial Strength and Profitability Drivers. The financial performance recorded in 2024 established a strong operational baseline following the volatile commodity price peaks of 2022. Equinor delivered total revenues of $103.774 billion and maintained high operational profitability, reporting an adjusted operating income of $29.8 billion. This robust performance validates the company's focus on operational efficiency and high-return assets. However, the analysis of quarterly results reveals material cyclical volatility and statutory complexity. The third quarter of 2025 highlights a significant divergence between core operational profitability and reported statutory net income. Despite resilient operational execution, which included 7% production growth with strong contributions from core assets like Johan Sverdrup and Johan Castberg, the reported result was a net loss of $0.20 billion. In sharp contrast, the adjusted operating income for the same period stood at $6.21 billion. This marked gap between GAAP net income and adjusted operating income requires a forensic approach. The Q3 2025 net loss occurred primarily because below-the-line items, specifically $754 million in net impairments and the impact of the structurally high Norwegian tax regime, exceeded the substantial operational margin. The impairments were chiefly driven by revised lower long-term price outlooks and strategic write-downs related to non-operated U.S. offshore assets and international holdings held for sale. Therefore, the use of AOI, which isolates core operational cash-generating capacity from these non-cash and jurisdictional charges, is essential for accurate cyclical comparisons and for assessing the health of the underlying business. The core operational profitability is strong and diversified, notably stabilized by the superior performance of the marketing, midstream, and processing segment, which effectively optimized European gas trading. 1.2 Capital Structure, Cash Generation, and Distribution Safety. Equinor's capital structure remains a significant competitive advantage. The firm holds long-term credit ratings of AA- from S&P Global Ratings and AA2 from Moody's, both assigned a stable outlook. This superior credit profile attests to the company's minimal leverage and strong financial flexibility. The adjusted net debt to capital employed ratio stood at a conservative 12.2% at the end of the third quarter of 2025, moving up slightly from a net cash position recorded in 2023, when the adjusted ratio was negative 21.6%. Management has explicitly committed to strengthening free cash flow, guiding for a substantial total FCF generation of $23 billion for the 2025 to 2027 period. This robust FCF outlook is crucial for fully funding the competitive shareholder distribution policy, which targets a total capital distribution of around $9 billion for 2025. A decisive shift in capital allocation has been observed, designed to materially enhance FCF generation. Management announced a reduction in the investment outlook for renewables and low-carbon solutions to around $5 billion in total after project financing for 2025 to 2027. This curtailment of aggressive spending on high CapEx, long-duration transition assets is a pragmatic move focused on optimizing capital efficiency. By redirecting capital towards high-return core oil and gas projects, expecting more than 10% growth in O&G production from 2024 to 2027, the company ensures the delivery of its targeted return on average capital employed (ROACE) above 15% towards 2030. This realignment significantly de-risks the short to medium-term cash flow profile, prioritizing shareholder returns from its most profitable segments. 1.3 Concluding Investment and Price Target Overview. Equinor is demonstrably undervalued by the market, trading at a substantial discount relative to both its peers and its intrinsic cash flow potential. The current trailing 12 months P/E ratio is approximately 10.1x, which is less than half the peer average of 22.2x. Furthermore, the company screens with an exceptionally low EV to EBITDA multiple of 1.8x. Crucially, the stock offers an attractive, high-quality free cash flow yield of 11.8%. Based on its fundamental financial strength, the strategic pivot toward high-return core assets, and the robust shareholder distribution plan, Equinor ASA have a positive rating. The persistent market valuation discount is judged to be significantly mispriced relative to the underlying operational resilience and cash generation capacity. Relative valuation analysis suggests the stock is currently undervalued by 38%, with a relative base case value of 369 NOK. The realization of the average annual FCF of $7.67 billion 2025 to 27, coupled with successful execution of the production growth targets, should catalyze a rapid market re-rating, driving valuation multiples towards parity with the integrated energy peer group and closing the deep valuation gap. Corporate strategy, operational context, and macro sensitivities. 2.1. Equinor's global position and the role of the Norwegian Continental Shelf. Equinor's operational foundation is intrinsically linked to the Norwegian Continental Shelf, where it holds a dominant position. This mature region is characterized by low operational lifting costs and a stable regulatory environment, providing a predictable, high-margin base for hydrocarbon production. A key strategic advantage is Equinor's status as the largest single supplier of natural gas to Europe, a position that has provided substantial geopolitical and financial stability, particularly benefiting from sustained elevated European gas prices since geopolitical events shifted supply dynamics. While the Norwegian Offshore Directorate projects hydrocarbon production to peak in 2025, Equinor's management strategy focuses on value creation and competitive, sustainable returns rather than pure volume expansion. The company targets a robust average annual cash flow from operations after tax of $20 billion from the oil and gas segment alone for the 2024 to 2030 period, reinforcing the priority of cash generation. The company's overall financial performance remains highly sensitive to commodity price fluctuations, primarily Brent crude and European natural gas prices. 2.2. The refined energy transition strategy. Equinor retains its long-term strategic vision of achieving net zero emissions by 2050. However, the strategic execution, formalized through the updated Energy Transition Plan (ETP), reflects a more rigorous, value-driven appraisal of capital deployment efficiency. The company has reduced its ambition for highly capital-intensive, long-duration renewables projects. The expected installed renewable energy capacity target has been lowered to 10 to 12 gigawatts by 2030. This is supported by the corresponding reduction in the capital investment outlook for renewables and low-carbon solutions, totaling just $5 billion for the 2025 to 27 period. The explicit curtailment of aggressive, prestige-driven spending on certain transition assets signals a strong assertion of capital discipline. Management is signaling that capital deployment will be strictly governed by the ability of projects to meet their internal 15% ROACs hurdle rate. This calculated reduction in investment on assets with potentially lower or longer duration returns is fundamentally designed to immediately boost FCF, which directly benefits shareholder distributions. Concurrently, Equinor maintains focused investment in other low-carbon solutions perceived to offer higher strategic value and regulatory support. This includes advancing carbon capture and storage projects, such as Northern Lights, which is set to begin commercial operations by 2025. The company targets substantial CCS capacity of 30 to 50 million tons of carbon dioxide per annum for transport and storage by 2035. This selective deployment suggests a belief that CCS and hydrogen capabilities offer a stronger competitive moat and a more defensible return profile than the increasingly commoditized utility-scale renewable power market. The strategy is now to maximize returns from the low-risk, high-margin core hydrocarbon business to fund shareholder distributions and maintain a strategic foothold in future low-carbon technologies with superior long-term viability.
2.3. Management guidance on production growth, cost structure, and targeted return on capital. The revised strategic blueprint emphasizes accelerating profitable hydrocarbon production growth, Equinor expects to deliver more than 10% oil and gas production growth from 2024 to 2027. This growth is projected to drive the expected organic capital expenditure of USD 13 billion for 2025, reducing to an average of USD 12.5 billion for 2026-2027. After accounting for project financing arrangements, such as the deal for Empire Wind I, the organic capex for 2025 is expected to be $11 billion. A critical operational indicator confirming the company's capital efficiency and cost structure resilience is the affirmation that Equinor can achieve a cash flow neutral status after all investments at an oil price around $50 per barrel. This low operational break-even price provides a substantial financial buffer against cyclical commodity volatility, establishing a high degree of certainty that the company can sustain both core capital expenditure and base dividend payments well into a moderate market downturn. This robust operational profile is designed to underpin the target ROACE of above 15% towards 2030. 2.4. Detailed analysis of commodity price exposure and earnings volatility. The income statement is directly exposed to volatility in realized liquids and European gas prices. The third quarter of 2025 illustrated this exposure, as realized liquids prices averaged $64 per barrel, a decrease of 12% year over year. 4. This decline in liquids pricing was the primary factor contributing to the 10% decrease in adjusted operating income. However, the integrated energy model proved its mitigating value through the performance of the marketing, midstream and processing (MMP) segment. Despite the substantial decline in realized liquids prices and weak speculative crude trading that negatively affected the crude products and liquids result, the company avoided a proportionally larger contraction in earnings. Strong performance from the gas and power subsegment, driven by the optimization of piped gas trading in Europe, provided critical stability and was the main contributor to adjusted operating income in Q3 2025. This operational agility underscores the necessity of viewing Equinor not solely as an upstream liquids producer, but as a hybrid energy stock whose profitability leverages favorable regional gas market dynamics and sophisticated trading capabilities to stabilize overall income generation, offsetting upstream liquids weakness. 3. Analysis of the income statement, profitability, and earnings quality. 3.1. Benchmarking 2024 performance against prior cycles, revenue and operating expense trends. The 2024 financial year reflected a normalization in pricing and profitability following the highly elevated energy prices seen in 2022. Total revenues and other income declined slightly to $103.74 billion in 2024 compared to $107.174 billion in 2023. This represents a modest revenue contraction of approximately 3.2%. Concurrently, total operating expenses for 2024 were $72.846 billion, up from $71.404 billion in 2023. This minimal contraction in revenue, coupled with slightly rising operating costs, established a lower yet still robust baseline profitability profile heading into 2025, confirming that price normalization slightly outweighed any volume gains achieved during the period. Net operating income for 2024 was $30.927 billion, down from $35.70 billion in 2023. 3.2. Dissection of adjusted operating income, segmental contributions, and operational efficiency. Adjusted operating income, AOI, remains the most pertinent metric for assessing the health of Equinor's core business as it strips out the volatile effects of non-cash items such as impairments and realized hedging impacts. As previously noted, the full year 2024 AOI reached $29.8 billion. Quarterly performance metrics further illustrate the underlying stability. In the third quarter of 2025, AOI reached $6.21 billion. Crucially, the composition of profitability drivers shifted materially during this quarter. The gas and power segment emerged as the main contributor to AOI. This demonstrates Equinor's exceptional flexibility and commercial strength in monetizing tight European gas demand, which was necessary to protect the quarterly income statement from the simultaneous negative effects of lower average liquids prices and losses stemming from hedging of shipping contracts and weak speculative crude trading.
The capacity of the integrated model to rapidly shift profitability drivers, leaning into high-margin gas optimization during periods of liquids price softening, is a key risk mitigant for overall earnings stability. 3.3. Assessing earnings quality, the frequency and impact of impairments and non-recurring items. The quality of Equinor's GAAP earnings is frequently penalized by substantial, though non-cash, below-the-line charges. This effect was evident in Q3 2025, where the net loss was primarily generated by $754 million in net impairments. These charges were explicitly tied to a conservative adjustment of the long-term price outlook and related to strategic exits or write-downs on non-core assets, specifically non-operated U.S. offshore assets and international holdings identified for sale. This recurring willingness by management to recognize significant impairments signals the adoption of a conservative long-term price deck. While generating statutory net losses in the current period, these non-cash charges enhance the quality of future earnings by strategically high-grading the portfolio. They lower the future depreciation and amortization burden associated with these assets and remove the risk of larger, unexpected future write-downs. This proactive approach supports the achievement of the targeted 15% ROACE by ensuring capital is only allocated to assets that meet or exceed stringent internal return metrics. 3.4. Forecasted earnings growth and forward PE ratio dynamics. Analyst consensus for Equinor forecasts a near-term cyclical trough followed by a strong recovery phase. Based on external forecasts, the price-to-earnings ratio, PE, growth rate is projected to experience a substantial decline of -24.31% in 2025, which is then expected to be followed by a sharp rebound of 20.53% in 2026. This projected volatility in trailing earnings supports the thesis that the current TTM PE ratio of 10.1x is based on a depressed earnings base that is anticipated to correct sharply upward. The primary volume catalyst necessary to deliver the steep 2026 earnings rebound is the planned acceleration in operational output. This includes the expected more than 10% oil and gas production growth planned to be delivered between 2024 and 2027, assuming commodity prices remain stable or moderately improve from the levels that precipitated the 2025 impairments. The anticipated growth trajectory provides the necessary volume leverage for earnings recovery. 4. Analysis of the cash flow statement, funding and flexibility. 4.1. Historical and projected cash flow from operations OCF. Equinor's cash flow from operations activities OCF follows the highly cyclical nature of oil and gas prices. OCF decreased substantially from the peak achieved in 2022, $35.13 billion, to $24.701 billion in 2023, and further declined to $20.11 billion in 2024. A closer look at the quarterly results provides crucial detail regarding underlying funding capacity. In the third quarter of 2025, cash flow provided by operating activities before taxes paid and working capital items was strong at $9.098 billion, an increase over the comparable quarter in 2024, largely driven by higher realized gas prices. However, the high taxation inherent to the Norwegian fiscal regime represents a massive mandatory drain on distributable cash. Equinor paid 2 NCS tax installments totaling USD 3.9 billion in Q3 2025. This non-discretionary outflow is the reason why the reported OCF, after taxes paid, of $5.33 billion is the superior metric for gauging true funding capacity available for investment and shareholder distribution. Despite the substantial tax drag, the post-tax OCF of $5.33 billion in Q3 25 was more than sufficient to cover the quarter's organic capital expenditure of $3.41 billion, confirming robust immediate free cash flow generation. 4.2. Deep dive into capital expenditure allocation, optimization, and discipline. Equinor's current capital expenditure strategy is optimized for free cash flow maximization and disciplined capital allocation. The organic CapEx guidance for 2025 is set at $13 billion, with an average CapEx of $12.5 billion projected for the 2026-2027 period. Total capital distribution is targeted at $9 billion for 2025. The decision to reduce the total investment outlook for lower carbon solutions to $5 billion total for 2025-2027 represents a high grading of the capital portfolio. This disciplined approach ensures that the investment schedule is highly manageable and focused predominantly on high-return, fast-payback core hydrocarbon projects necessary for meeting the 10% production growth target. Furthermore, Equinor's successful utilization of project financing, such as for the Empire Wind I project, effectively reduces the company's direct cash outlay, enhancing overall free cash flow efficiency and shielding the balance sheet. 4.3. Modeling free cash flow (FCF) generation and the FCF neutral break-even price. Free cash flow (FCF) generation is the core determinant of Equinor's capacity for shareholder returns and is central to the valuation thesis. FCF is projected to total $23 billion for the 2025-2027 period, equating to an average annual FCF of approximately $7.67 billion. The certainty of this FCF outlook is significantly reinforced by Equinor's highly efficient operational profile. Management guidance affirms that the company is cash flow neutral after all investments at an oil price of around $50 per barrel. This low FCF neutral price is a critical operational indicator. It confirms that the projected average annual FCF of $7.67 billion is achievable even if oil prices trade significantly below the Q3 2025 realized price of $64.09 per barrel. This high certainty in cash generation provides investors with a substantial operational margin of safety and validates the 11.8% FCF yield 10 as a reliable measure of intrinsic value, suggesting low operational risk across a wide range of commodity prices. 4.4. Analysis of cash flow utilization, debt reduction versus shareholder returns. Given Equinor's extremely conservative balance sheet and minimal leverage position, net debt/CE adjusted ratio of 12.2%, cash flow utilization is overwhelmingly weighted towards shareholder returns rather than necessary deleveraging. The aggressive $9 billion total capital distribution target for 2025 nearly consumes the projected $7.67 billion average annual FCF. This suggests that management is prioritizing maximizing near-term shareholder payouts, relying on working capital optimization, and the potential for higher-than-average commodity prices to bridge the marginal funding gap between the average FCF guidance and the distribution target. This prioritization of returns reinforces the company's commitment to providing competitive capital distribution, utilizing the balance sheet strength achieved through prior years of strong cash generation. V. Analysis of the balance sheet, structural strength and capital resilience. 5.1. Evaluation of gross interest-bearing debt and equity position. Equinor's balance sheet structure is characterized by high asset value and conservative debt levels, positioning it favorably within the integrated energy sector. As of the end of 2024, total assets amounted to $131.141 billion, with gross interest-bearing debt standing at $30.094 billion. A notable trend observed is the movement in shareholders' equity, which decreased from $48.49 billion in 2023 to $42.34 billion in 2024. While strong underlying profitability should increase book equity, this reduction is a direct and deliberate consequence of the aggressive capital return policy, particularly the significant share buyback program. This is not a signal of financial distress, but rather a strategic financial maneuver intended to optimize the capital base by reducing the share count. This optimization directly supports the company's objective of enhancing return on equity, ROE, and achieving the targeted 15% ROCE by shrinking the equity base. 5.2. Analysis of the net debt to capital employed ratio, adjusted, and deleveraging capacity. The net debt to capital employed ratio, particularly the adjusted figure, is a key benchmark for evaluating Equinor's financial discipline and leverage. Historical data shows significant volatility during the period of high energy prices, with the adjusted ratio reaching a net cash position of minus 21.6% in 2023. As profitability normalized, the ratio shifted slightly, standing at 11.9% in 2024 and 12.2% at the end of Q3 2025. This ratio is remarkably low, maintaining a position significantly below the peer group average. The maintenance of such low leverage confirms robust financial flexibility and high resilience against price shocks, ensuring that the company can sustain its projected production investment schedule through virtually any expected cyclical downturn without relying on external financing. 5.3. Assessment of Equinor's superior credit ratings and long-term debt strategy. Equinor possesses one of the strongest credit profiles among global integrated energy majors, a critical structural advantage. The company maintains long-term credit ratings of AA- from S&P and AA2 from Moody's, both with a stable outlook. The company's debt strategy is highly proactive, emphasizing the mitigation of refinancing risk by maintaining a smooth maturity profile. The total remaining long-term bond debt amounts to $23.2 billion, structured with a long average year to maturity of 8.5 years as of November 2025. This superior credit rating and meticulously managed debt maturity profile provides a material competitive advantage through a lower cost of debt. In the current high interest rate environment, this structural strength translates directly into substantial savings on annual interest expense compared to lower-rated peers, further strengthening the overall free cash flow generation capacity necessary to fund capital-intensive long-life projects in both hydrocarbon and low-carbon segments. 5.4. Liquidity position and short-term working capital management. Equinor maintains a robust liquidity position. As of 2024, cash and cash equivalents were reported at $8.12 billion. Furthermore, the current ratio is healthy at 1.47. This substantial liquidity ensures that the company is well positioned to meet its short-term operational and financial obligations, crucially, providing the capacity to handle the massive periodic tax installment payments required by the Norwegian state, $3.9 billion paid in Q3 25 alone, without placing undue strain on operational cash flow or necessitating short-term borrowing.
V. Dividend safety and competitive shareholder returns. 6.1. The dual-component capital distribution framework, ordinary and extraordinary payments. Equinor has established a sophisticated two-tiered capital distribution system designed to provide predictability while maintaining flexibility in the face of cyclical commodity markets. The structure consists of a fixed, stable ordinary cash dividend of $0.37 per share quarterly, providing investors with a reliable income foundation. Flexibility and upside are delivered through a substantial share buyback program, which, combined with the ordinary dividend, is expected to deliver a massive total capital distribution target of around $9 billion for 2025. 6.2. Quantitative assessment of dividend coverage by operating cash flow and free cash flow. The safety and sustainability of Equinor's distributions are anchored in its robust projected free cash flow (FCF). With an average annual FCF projection of approximately $7.67 billion for 2025-2027, the total $9 billion distribution target implies a coverage ratio slightly below 1x based solely on the average FCF guidance. However, this is tempered by the high underlying FCF yield of 11.8% and the extremely low $50 per barrel cash flow neutral price. The intentional use of the share buyback program as the larger discretionary component of the distribution package serves as a crucial financial buffer. This mechanism allows management to ensure the stability and preservation of the core 0.37 quarterly ordinary dividend across all expected price cycles. Should commodity prices unexpectedly weaken, management can adjust the buyback tranche, e.g. the Q3 2025 tranche was up to $1.266 billion, without cutting the fixed quarterly dividend, thereby protecting investor confidence in the base return and insulating capital structure decisions from short-term market noise. The ordinary dividend, covered by the $50 per barrel break-even price, is judged to be highly secure. 6.3. The role and scale of the share buyback program in total shareholder yield. The share buyback component is integral to driving the total shareholder return and maximizing capital efficiency. The large-scale buyback program contributes substantially to the overall distribution, leading to estimates of a total forward dividend yield of up to 10.3% in 2024.
The buybacks are critical not only for achieving the high targeted yield, but also for optimizing corporate financial metrics. By aggressively repurchasing shares, the company reduces the outstanding share count, which amplifies earnings per share (EPS) and contributes directly to achieving the higher ROACE target by shrinking the equity base, as demonstrated by the reduction in shareholder equity from 2023 to 2024. 6.4. Long-term sustainability of returns against investment needs and strategic transition. The long-term sustainability of this competitive total distribution is directly dependent on the successful execution of Equinor's revised strategic plan. This requires achieving the targeted more than 10% oil and gas production growth and maintaining the strict capital expenditure discipline articulated in the 2025-2027 guidance. If production growth successfully materializes and commodity prices remain above the robust $50 per barrel cash flow break-even, the FCF outlook is highly secure, ensuring the continuation of competitive shareholder returns for the foreseeable future. The combination of a high FCF yield, conservative balance sheet, and management's explicit commitment to capital return positions Equinor as a high-yield value stock. The principal risk to long-term sustainability is execution risk on the production growth trajectory, rather than systemic financial weakness. 7. Valuation assessment. 7.1. Comparative analysis of price to earnings (PE) and EV (enterprise value to EBITDA) multiples. Equinor currently screens as fundamentally undervalued based on a comprehensive review of standard valuation metrics, exhibiting a compelling discount relative to its peers. The trailing 12 months PE ratio of 10.1x is significantly lower than the integrated energy peer average of 22.2x. Furthermore, the analysis indicates that Equinor's current PE is trading far below its estimated fair PE of 18.8x. The most striking indication of mispricing is the enterprise value to EBITDA multiple of 1.8x. Such a low multiple is typically assigned to companies facing severe structural decline or imminent financial distress. This valuation is fundamentally contradicted by management's confident guidance of more than 10% production growth over the medium term and the targeted 15+ ROACE through 2030. The market is implicitly assuming a far harsher terminal decline rate for Equinor's core hydrocarbon business than is warranted by the firm's operational efficiency, financial resilience, and strategic capital discipline. This severe discount suggests the market is applying a substantial, almost punitive risk premium that is inconsistent with the underlying quality of the cash flows and balance sheet. 7.2. Interpretation of free cash flow yield as a discounted cash flow proxy. The free cash flow yield provides the most compelling quantitative evidence of undervaluation. Equinor offers an attractive 11.8% FCF yield. This figure compares favorably to major European integrated peers, sitting only slightly below Shell, 12.7, and notably above Total Energies, 8.5. The quality of this yield must be heavily emphasized. Unlike some high FCF yield companies, Equinor's yield is supported by exceptional financial stability, affirmed by the AA-, AA2 credit ratings, and a low-risk, politically stable operational base centered on the NCS. The high yield, combined with superior credit quality, suggests that the market is failing to appropriately differentiate Equinor's high-quality, stable FCF streams from those subject to greater cyclical volatility or geopolitical risk. The 11.8% FCF yield offers a substantial margin of safety for investors, implying a necessary rate of return that should otherwise reflect a much riskier business model than objective financial data supports. 7.3. Qualitative factors driving the valuation discount, transition risk, and regulatory environment. The persistent valuation discount, evidenced by the PE and EV/EBITDA divergence, can be primarily attributed to qualitative factors rather than fundamental financial weakness. The principal headwinds include the market's enduring skepticism regarding the long-term cost and timeline of the energy transition, particularly given Equinor's historical commitment to green technologies, despite the recent capex reduction. Furthermore, there is a perceived regulatory risk associated with Equinor's status as a majority Norwegian state-owned entity, potentially hindering its agility compared to fully private peers. Finally, the expected short-term negative PE growth forecasted for 2025, negative 24.31%, may temporarily deter growth-focused funds, masking the impending 2026 earnings recovery. 7.4. Conclusion and pathways to market re-rating. The investment thesis rests on the inevitable market re-rating once the strategic pivot is successfully executed and reflected in realized shareholder returns. The primary catalysts for this re-rating include the successful execution of the renewed capital distribution strategy, maintaining the 0.37 quarterly dividend, and completing the $9 billion total distribution target, and the realization of the 10-plus production targets. If Equinor delivers the guided average annual FCF of $7.67 billion over the 2025-2027 period, the market will be compelled to re-rate the stock, moving its PE and EV/EBITDA multiples closer to its integrated peer group average. Relative valuation models estimate Equinor's value at 369.19 NOK, suggesting the stock is undervalued by 38%. This conclusion aligns with the quantitative data, which shows Equinor is currently priced as a value trap, but is fundamentally operating as a high-return, financially disciplined integrated major with a structural cost of capital advantage. The investment opportunity lies in the significant discount that currently exists between the company's superior financial quality and its pessimistic market valuation.